weekly outlook report. This is the only show where the stock market's sugar high meets a jobs report that could rip the IV straight out of its arm. I'm your host, and today we're about to roast Wall Street's blind optimism, one data point at a time. The S&P at record highs, Nasdaq soaring like it's hopped up on Red Bull and NVDA chips, Dow Jones pulling new all-time besties. Yeah, but don't get too comfy, because this week Uncle Sam's jobs numbers are about to kick in the door like the feds at a Ponzi scheme. So to kick things off, let's go ahead and rewind the tape and recap what all went down last week. The S&P 500 closed up 3.5% on the week. The Nasdaq was up 4.1% on the week, and the Dow even joined in, your grandpa's stock with the party with a 3.8% gain. Now, why did this happen? Because Powell, our monetary zaddy, told everyone he's well positioned to wait. Rate cuts? Maybe, but not yet. And the market interpreted that like a toddler hearing maybe we'll go to Disneyland. Bullish as hell. Throw in weak jobless claims, softer growth data, Trump chilling for once on his July 9 tariff threats. And you get a cocktail of cheap money dreams, AI FOMO, and let's be honest, willful ignorance. But here's the brick wall in the middle of the dance floor, Thursday's jobs report. So let's unpack this because it's the main event of the week, and this is really what you need to know. So Thursday, July 4th, happy birthday, America. Now hold my beer while I drop payrolls data. The consensus here is we're expecting 110,000 non-farm payrolls. Unemployment to be at 4.3%, and wage growth slowing to 0.3% month over month. Wall Street is praying for a soft number. Why? Because a weak jobs print equals rate cuts in September. And that means they're basically gift wrapped at that point. Because if you remember last year, when we got our rate cut, it was in July, and it was because the jobs data was weak and the labor market was crumbling. So this cut would be to protect the labor market. But if we get a hot jobs print like 200,000 plus jobs, the Fed might hit the pause button on cuts, the bond market will puke, and the entire sugar rush rally could faceplant harder than a meme stock trader on margin. Keep your eyes on Thursday. Red circle it, star it, tattoo it on your forehead, carve it into your arm, do whatever you have to do. Next, the human volatility generator himself, Donald J. Trump. Is July 9th the real deadline for tariffs? Maybe, maybe not. Is he nuking Canada next week? Who the hell knows? One day, Trump's team is hinting at the end of summer wrap-up on tariffs. The next day, he's raging online that Canada deal is toast by next Monday. Behind the scenes, the Treasury's confused, trade reps are confused. Hell, even Trump's dog is probably confused at this point. But here's why you need to care. Tariffs aren't settled. They're a ticking time bomb under earnings, consumer prices, and market sentiment. One tweet can blow up your entire bullish thesis, so do not sleep on this. Now, the Fed is out here trying to play 4D chess while everyone else is eating Play-Doh. Markets are basically begging for a September rate cut. We have 93% odds for September, and July cut odds drifted up to 18%. Fed speakers like Bauman are hinting at downside labor risk. Basically, they're seeing the labor market slowing, but Powell, he's still rolling the dice. We're well positioned to wait is what he keeps repeating. The translation, if Thursday's data is soft, we'll look heroic with a September cut. If it's hot, we'll punt to November and you'll cry about it. Keep your bingo card handy. But that's enough macro boring stuff. Let's talk about why your Robinhood portfolio is green. Tech and AI are still on a face-melting run. NVIDIA is at a record high again. Amazon, upgrades galore. QuantumScape, plus 30% on battery breakthroughs. And Core Scientific, up 28% on buyout rumors with NVIDIA-backed CoreWeave. The theme, AI plus energy transition, is the ultimate YOLO trade. And as long as bond yields chill, big tech might just keep moonwalking over everything. So, quick pit stop, by the way. Let's rapid fire what's cooking this week. Monday, we have Chicago PMI, still trash, 42.7 expected. Then we have Dallas Fed manufacturing, less trash, but still trash. Tuesday, we have JOLTS job openings might dip. We have ISM manufacturing below 50 means still contraction, and construction spending. A mild rebound's expected here. Wednesday, we have ADP jobs, moderate growth. We have challenger job cuts, still high but stabilizing. We have Fed beige book as well, and that's where we watch tariff mentions. On Thursday, we have our big day, the main event, non-farm payrolls. Then we have ISM services, which are expected to be modestly stronger. And then we also have durable goods, strong aerospace area. And we also have US composite PMI 52.8 expected. Now, let's talk trade setup. Here's your playbook. Soft jobs print, stay long on tech, housing, utilities, and AI. Hot jobs print, fade tech, watch for bond yields to spike, maybe play energy or commodities. Trump tariff bomb, rotate to commodities and energy defensives. The bottom line, a 4-day week doesn't mean 4 days of calm. This is going to be a clown car fire drill. Final word, degenerates. Wall Street is riding maximum optimism. Record highs, a cheap dollar, fading yields, and everyone drunk on the AI Kool-Aid. But it's a house of cards on Thursday's jobs report. One strong print, one crazy Trump tweet, and this rally could wobble like a drunk uncle at Thanksgiving. Stay hedged, stay nimble, watch Thursday, and remember, not financial advice, just decoding the circus with a mic and a wink. Drop a comment. Which landmine do you think blows up first this week? Hot jobs, Trump's tariffs, or do we keep printing new highs? Let me know below. Smash that like, subscribe, and turn on your bell notifications so you never miss a Trades and Gains update. And I'll see you tomorrow for our daily recap, assuming the market's still alive, by the way, and it hasn't completely exploded. Have a great Sunday. See you in the next one.